Welcome to this edition of Real World Business Law, where we discuss real-world issues impacting businesses and executives. I'm Declan Leonard. I'm managing partner here at Berenzweig Leonard, and I also head up the firm's employment law practice.
And my name is J.R. Tulloch, and I'm associate here with the firm's corporate transactional.
Yeah, and we're coming here live from BLC Digital Strategy Studio here in Tysons. Always great to be in here. We've got Todd out there, our great producer, Todd Castleberry, the president of BLC Digital Strategies. And JR, it's great to be in the studio with you. You know, you and I in particular work on a lot of these business deals, and basically when a company's either selling or buying another company, you know, we work on these together. And I think it's fair to say that we see a lot of the same issues that pop up in various ways in these deals. Isn't that right?
Yeah, exactly. And I have to start off by saying this is my very first podcast, so I'm glad to be here trying to add some value to our clients.
Yeah, no, I'm glad you came in. You got a lot of experience doing these deals, so I think you've got a lot to offer for today's topic. So we thought we would do, you know, the typical top five type list. Before we jump into that, though, walk us through just very high level the process when somebody's either buying or selling a company.
So I think with like any kind of typical transaction, it starts off with a conversation between the parties, and that leads into a non-binding letter of intent where we lay out some of the initial agreement aspects and try to get something papered. And
so the LOI is usually just like it is a letter. It's a letter of intent, or sometimes it's called an MOU, Memorandum of Understanding. Got to have an acronym in this town. Yeah. But as you said, it's non-binding. But you know what? We see that the parties, the buyers and sellers, often they spend a lot of time getting to that point of the LOI. Isn't that correct?
Yeah, absolutely. The lead up to that is there's a lot of preparation that goes into it. You want to make sure that as many of the details are ironed out before we get into drafting those main documents.
Okay, you get the LOI in place. What happens next?
Then we go into due diligence, which is just making sure that there are no surprises after we enter into a deal. Make sure we get all the skeletons out of the closet and that kind of stuff.
Yeah, it's basically the buyer wanting to lift up the hood, check things out, look at the finances of the company, look at the employment agreements, make sure customer contracts, things like that, the things that they're looking to buy to make sure all's in order. Make sure there's no, like you said, skeletons, no sitting issues like FLSA overtime unpaid and stuff like that. So that's their way of doing that. And then what happens after due diligence?
After due diligence, we start drafting the main agreements, get everything papered so that we can get the deal signed and closed.
Okay. And so when you say the main documents, that's what we're going to be talking about today. The issues that we see come up time and time again in those main documents, those are the binding documents that actually formulate the deal. So the first one is the structure of the deal. Talk about the structure of the deal and how that becomes an issue in these documents.
Right, and I think it's important to note that each of these subsections could probably have its own podcast. But you know, first and foremost, the structure of the deal, we want to look at, is it an asset sale or is it a stock sale? Okay. And what's important with that is a lot of times asset sales are better for the purchaser, stock sales are better for the seller, and what drives that is tax implications, liability being transferred, all those sorts of things.
Okay, so sellers like the stock sale because without getting too deep into the tax side of things, they can get favorable capital gains tax treatment.
Yep. Absolutely, and the buyer also takes all of that liability.
Yeah, so of course the buyer on the other side wants an asset purchase, meaning we're not buying the company, we're just buying certain assets of the company. The company will still exist, it may be a shell at the end of it. And explain why a buyer prefers that mechanism.
So with an asset sale, a buyer can really pick and choose exactly what they want to take out of the company, and that includes taking hard assets, soft assets, but also it gives them the opportunity to leave those liabilities with the seller.
Okay, so it's a little bit more. It's a little bit more, I guess, risk averse for the buyer to do an asset purchase, and so that's what they prefer. And actually, again, without getting too deep into the tax aspects of this, you actually there are ways to have sort of the best of both worlds when it comes to this through what are basically called tax code elections. Right. Again, that one could be probably 3 podcasts at least. We'd have to have our friend having Scott Dondershine in on that one. But there are tax elections that can be done so that it can be structured so that really the buyer and the seller each get what they want out of this.
Right, and we always advise our clients to get a great accountant up front because a lot of these tax implications are gonna be a big deal down the road.
Yeah. Definitely. Never should do these deals without the involvement of the company's CPA firm or an outside CPA firm, as well as just really experienced tax counsel, because it's a minefield when it comes to some of this stuff. Okay, so the next thing, purchase price. Obviously, from the seller's perspective, that's always top of mind. What's the purchase price? So let's talk about that, because people say all the time, I got X amount of money for my company. I always think about that and I say, what does that even really mean? Like, rarely do people just get a check for that amount of money. I mean, I guess Elon Musk might have done that recently, but that's about it. Talk about how the purchase price usually works.
So the purchase price can be broken down into a couple different variants, and that's cash, liquid cash up front.
Just like at the closing when you're signing the documents, here's the wire transfer that's going into the seller's account.
Exactly. And then another variant is called equity. So what happens there is the purchaser will give the seller equity in their company going forward. And a lot of times shareholders don't like that very much because they're not getting those distributions on the back end. But it is a good.
Yeah. So in other words, my experience on that is, it depends on, every deal is different, but my experience is the seller, the shareholder who's selling, usually they kind of just want to wash their hands out of being an owner.
Right.
And so the notion that they're then taking on equity in the buying company is not always so attractive. Now, again, it could be that that's a very advantageous and they don't need that cash immediately. So that's right. That's another one. What else sits out there in terms of under the guise of purchase price?
A big one is earnouts.
Okay. What are earnouts?
Essentially, the seller will receive distributions from the buyer over a certain period of time, whether that's months to years. And a lot of times they will have qualifiers.
It's usually, tied to performance.
Right.
So, for instance, a lot of our clients are government contractors. We'll pay you an additional X amount of money if the option year of one of the contracts that we're taking over is exercised. So that's not a definite part of the purchase price. It's contingent. It's got strings attached. But that's another thing that very, very common in these deals under purchase price. What else sits out there?
A highly contested topic is net working capital.
Sounds complicated.
So if you think of it like gas in a car. So when you buy a car from the dealership, they give you a full tank of gas most of the time.
Yeah.
And that gas is meant to get you down the road. It's meant to get you home. It's meant to get you to your next destination. Net working capital is the exact same thing. It's intended to make sure that the company can still function and pay its bills while you're getting ramped up. Okay.
So it's basically a requirement that the seller leave a certain amount of money, certain amount of gas in the tank, certain amount of money in the operating account when they sell. So rarely in these deals do you have a situation where the seller sells the company to the buyer, but first just takes all of the cash out. There's got to be what they call working capital or net working capital, more money in the thing. And so obviously buyer wants as much of that money to be in there because it really becomes part of almost like a deduction of the purchase price, because that's money that's that they get to keep.
Exactly. And that's why it's always so highly contested, because the seller doesn't want to leave that money in.
Okay. And then what's maybe another component?
One thing we look at a lot is escrow. And escrow is essentially money left in the company separate of net working capital that can cover any indemnification issues, and we'll get into that in a second, or issues that come down the line where we have to cover certain costs.
Okay, so buyer basically tells the seller, hey, listen, there's a couple of things that we're a little bit worried about. This case may, an employee may make a claim for overtime, or there might be something. Keep a certain amount of money in what's really an escrow account, which is like a trust account. So it's not money that's definitely going to the buyer. It's basically putting money aside in case something happens.
Exactly.
And we'll get into that in a little while, but that's also hotly contested because, again, it comes out of the seller's funds. The seller wants as much money at that closing table as they possibly can walk away with, and you get all these little sort of slices of the pie that come out of it.
And a lot of times with escrows, there is that temporal contingency. So if none of that money is taken out, or whatever is left will go back to the seller after a year or so.
Okay. And then as a subpart of purchase price, one issue that we also see come up is, how is the buyer going to pay for this? How are they going to, I mean, usually these deals are millions of dollars, that are going to the seller. What are some of the ways, without getting too deep into it, what are some of the ways that we see buyers financing these purchase price?
So typically you can go down the street to a bank. You can do venture capital, private equity. You can also, there are small business loans through the government that are always an option. There are a number of ways that, and it's important that clients go through and look to see what is most advantageous for them.
Okay, especially in today's economic climate with interest rates, being where they are, there's a lot of competition, trying to get cheapest dollars, I guess, to finance this.
Right.
Okay, let's hit another one of the issues that we see, employment issues. Specifically, when you're buying a company, whether it's an asset purchase or whether it's a stock purchase, you're buying a couple of things. Most of our clients tend to be service-based, government contractors and stuff. So you're in essence buying employees. It's not, in the pejorative sense, but you're in essence buying those relationships,
right.
Because at the end of the day, you want to have the company that the seller previously operated. So what are some of the issues that we see there?
Right. And, employees are some of the most important assets that a company has. And so CEOs always like to see that their employees are going to be taken care of after closing. And a lot of times, it's a lot of HR. It's a lot of transferring, a lot of selection of what employees you want to come, what employees you don't want to take on, payment of PTO and vacation, those sorts of things.
Okay, so making sure that it's a smooth transition. I mean, the worst nightmare for a buyer is you buy the company and then there's a mass exodus and everyone leaves. And so, and goes down to your closest competitor.
Right.
And so restrictive covenants, talk about how that comes into play.
Right, so a lot of employee contracts will have restrictive covenants, non-solicitive employees, non-competes. So we want to make sure that they aren't running down the street, like you said, to the next closest competitor. And we have to make sure that we're upholding those things, and those things are enforced post-closing.
Okay. So in other words, that the buyer has some protection that, after the signing happens and after the closing happens, that those employees will still be there. And much of that happens during the due diligence process, right?
Exactly. And at that time, most buyers will have a good sense of what employees they want to retain and what employees they want to let go to the wayside. Okay.
And so we talked about employees and how important that is, and how that's a key part of these deals. But a buyer is also buying, your customers, potentially, your contracts and stuff like that. So talk about that process.
Yeah, so within the due diligence process, we'll make sure that we get a comprehensive list of all the customer contracts and vendor contracts that a company has to make sure we know where the goods and where the services are coming from, as well as who we are performing for and what's expected of us through those contracts.
And one of the things we look at is it even assignable in the first place? So in the case of an asset purchase where we're not actually buying the full company, we're actually just taking on the operations or the assets of the company, of the seller. You want to make sure that those contracts allow assignability, because we're now company XYZ that's going to be stepping in and performing, and those contracts may very well have not allow assigning the contract over.
Right, and the client on the back end will be super confused when you're trying to perform services.
That's right. So that's another. It's a big issue that comes up in the deals. Again, that's another key aspect of the due diligence process. Hopefully, by the time the parties get to the closing table, they will have worked out a lot of those issues.
Exactly.
I'll just, as a subset of that issue, of the issue of contracts and customer relationships, a lot of our clients are government contractors, and so you got to oftentimes go through the novation process. What is that process?
So novation is just the process that the government goes through to assign a contract to another party. Sometimes, and this is a huge topic for our GovCon department here at the firm, but just making sure that you go through the proper steps, that the government knows that you are trying to transfer that contract, and and get it novated properly.
Yeah, so it almost inserts a third party into the deal,
Right.
Because it's not just like the buyer and seller can agree amongst themselves that, let's just say, the buyer takes over this government contract. They've got to get permission through this novation process. It's routinely done, so it's not like, it's not insurmountable, but it is something that you've got to start early in the process. You better have coordinated that. Easy for me to say.
Yep.
And then the last thing we're going to talk about is reps and warranties, and then as a part of that, indemnification.
Exactly.
Talk about like what reps and warranties are and where they show up in one of these written deals.
Reps and warranties has to be one of the most heavily negotiated aspects of a purchase agreement. And it all comes down to, how does the company function? Are they doing the things that they need to do? Have they paid off their taxes? If one big topic now are PPP loans that the government gave out for COVID, were those paid off? Are they up to date on making their payments if they weren't paid off?
Or got forgiven, yeah.
Or got forgiven, exactly. Yeah. And those reps and warranties are basically, we just go through every scenario and they represent and they warrant that they have handled those topics properly.
Yeah, so an example of a rep and warranty, which are usually, they take up probably, definitely a large part of these written purchase or asset sale agreements.
Right.
They're usually multiple pages long, and both the buyer and seller is required to do these reps and warranties. And so what they literally are they literally are the seller will say, I hereby rep and warranty that the company has paid its taxes for the last, some odd years. And so it's basically it's kind of like the skeletons in the closet that you talked about earlier. It's basically saying there are no skeletons, and I'm repping and warranting this. Why? What's the sort of catch in terms of, like, who cares? What if a seller just says that but they're wrong, like they misrepresent it? What recourse do we usually build into these agreements?
So typically, the reps and warrants will go down each. Let's take taxes, for example. We are agreeing to take on any of the liabilities that we are told about, that we are notified of, that are in the disclosures upon closing. And if we don't know about them, if they aren't disclosed to us, if we haven't assumed those liabilities, then we don't assume them. If it comes up later after closing, that's not our problem. Okay.
And what we often see is money set aside, escrowed money. We talked about escrowed earlier, escrowed funds. So the parties, the buyer will say, okay, seller, put your money where your mouth is. Right. I understand that you're telling us you paid your taxes, that there's no known liabilities against any employees. Right. You've paid them in accordance with the Fair Labor Standards Act, all those different things. Put your money where your mouth is for a period of, and this is another part of the negotiations, for a period of a year or 2 years or 3 years, put a certain amount of money aside. It won't be our money. It won't be the buyer's money unless one of those turns out not to be true, and buyer all of a sudden finds itself hit with one of these seller liabilities because they lied.
Right.
And so they'll then dip into that escrow fund to pay them.
A big alternative to an escrow fund for indemnification purposes nowadays, this is a modern creation, is reps and warranties insurance. So a lot of times sellers won't want to leave in that indemnification amount or that escrow amount. And a good alternative for buyers, if you still want the deal to go forward, is representation and warranties insurance. That's
a great point. We've seen that more and more with our deals. Well, listen, JR, this was really, really helpful. As you said, we're really just scratching the surface on this. We could get deep into all of these different things, but I think what this does is it gives anybody who's looking to sell or anybody that's looking to buy, it kind of sets the scene of how that process goes. So I appreciate you joining me today here in the studio.
Yeah, and I hope to be back. And if I can underline one thing, it's start early and start big.
Very, very good advice. Thanks, everyone, for joining us.
Thanks, guys.